The market is not your primary opponent. Charts move. News breaks. Volatility expands and contracts. Yet none of these forces press the buy or sell button. That action comes from you. The real battlefield in trading is internal. It is the space between stimulus and response. Every trader begins with analysis. Indicators, patterns, macro events, price structure. Over time, most discover that knowledge alone does not produce consistency. Two traders can read the same chart and take opposite actions. The difference is rarely intelligence. It is emotional regulation. Trading exposes the nervous system to uncertainty repeatedly. Gains trigger excitement. Losses trigger fear. Missed opportunities trigger frustration. Without discipline, these reactions compound into erratic behavior. Before understanding strategy, you must understand your emotional baseline. Emotional baseline is your neutral psychological state before market exposure. It is the calm, balanced condition from which clear decisions are made. When you deviate from it, perception distorts. Many traders sit down at their screen already agitated. They carry stress from earlier conversations. They feel urgency to recover yesterday's loss. They feel pressure to perform. From this unstable baseline, every tick appears amplified. Imagine a trader who ended the previous session with a significant loss. He wakes up determined to make it back. He opens his platform early, scanning aggressively for setups. When price begins to move, he enters without full confirmation, rationalizing that speed is necessary. The trade moves slightly against him. Instead of respecting his stop, he widens it, telling himself the market will turn. When it does not, frustration escalates. He exits impulsively, only to watch price reverse afterward. Anger rises. He enters again, this time larger. By midday, the original loss has doubled. The market did not defeat him. Emotional escalation did. Internal volatility mirrors external volatility. If your mind swings with every price fluctuation, you become reactive. Professionals train themselves to separate movement from meaning. Not every tick demands action. Not every loss demands correction. The first discipline is awareness. Notice the physical signs of emotional shift: tightened shoulders, shallow breathing, accelerated decision-making, compulsive chart switching. These are early warnings of cognitive drift, the gradual deviation from plan due to emotional influence. Drift rarely announces itself loudly. It begins subtly, disguised as intuition or urgency. Professional traders treat emotional regulation as part of preparation, not as an afterthought. They do not wait for chaos to begin managing themselves. They establish routines that stabilize their baseline before exposure. This may include reviewing a written plan, defining acceptable risk for the day, or sitting quietly for several minutes before the opening bell. The objective is not relaxation for its own sake. It is control. Markets are neutral environments. They do not reward desire. They do not punish frustration. They simply reflect supply and demand. When you interpret movement as personal success or failure, emotion intensifies unnecessarily. A critical mental shift occurs when you stop trying to conquer the market and begin managing your own reactions to it. Control moves inward. Responsibility becomes clear. Begin building this control with a simple daily ritual. Before each trading session, pause for 2 minutes without looking at charts. Observe your breathing and identify your current emotional state without judgment. If you detect agitation, impatience, or urgency, acknowledge it directly. Then define one intention for the session, such as executing only predefined setups or respecting every stop without exception. Write that intention down physically. This small act anchors awareness and stabilizes your baseline. Over time, this practice sharpens self-recognition. You begin to detect drift early rather than after damage occurs. Professional performance in trading is less about predicting correctly and more about responding consistently. Emotional spikes are inevitable. Allowing them to dictate action is optional. When your internal state remains steady, price movement becomes information rather than provocation. You observe instead of react. You execute instead of chase. The market tests discipline relentlessly. It tempts with rapid gains and pressures with sudden losses. Those who master emotional control recognize that every session is psychological training. Your edge begins not with strategy, but with stability. If you cannot regulate yourself, no system will save you. If you can, even simple systems become powerful. The battlefield is internal. Win there first. Emotion does not sabotage a trade all at once. It begins as a whisper. A slight urgency to enter early. A quiet hesitation to take a valid setup. A subtle increase in position size because the last trade worked. These shifts are small, almost invisible. Left unchecked, they compound into inconsistency. Emotional control in trading begins with recognition. You cannot regulate what you do not detect. Emotional awareness before execution means identifying internal shifts before they influence action. It is the discipline of observing your state in real time and comparing it to your emotional baseline. When awareness sharpens, impulse weakens. Most traders become aware of emotion only after a mistake, after the oversized loss, after the revenge trade, after the impulsive exit. Professionals reverse the sequence. They monitor their internal state continuously, especially before pressing the button. Fear often disguises itself as caution. Overconfidence disguises itself as conviction. Impatience disguises itself as decisiveness. Without awareness, these distortions feel rational. Imagine a trader who has just experienced 3 consecutive winning trades. His confidence rises. He begins scanning more aggressively, convinced he has read the market well today. A setup appears that almost meets his criteria. Normally, he would wait for confirmation. Today, he enters early. Price hesitates. Instead of accepting that the entry was premature, he adds to the position, certain the move will extend. The market reverses sharply. What began as confidence became cognitive drift. The deviation was subtle at first. By the time it became visible, capital was exposed. Emotional awareness interrupts this escalation. Before entering any trade, pause and ask a direct internal question. What am I feeling right now? Not what do I think? What do I feel? Calm focus feels different from urgency. Confidence feels different from excitement. Discipline feels different from pressure. Physical cues often reveal emotion faster than thought. Notice your breathing. Notice the tension in your jaw or hands. Notice whether your eyes are scanning frantically or steadily. The body signals drift before the mind admits it. Another distortion arises after loss. A trader takes a planned stop. The loss is within risk limits, but internally frustration builds. The next setup appears valid. However, instead of evaluating it objectively, the trader sees it as an opportunity to recover. The motive shifts from execution to compensation. That shift, if unnoticed, alters decision quality. Professional traders create small checkpoints before execution. They do not rely on willpower alone. They integrate awareness into routine. One effective practice is verbal confirmation. Before entering, state quietly, "This trade fits my criteria. My risk is predefined. I accept the outcome." If you feel resistance to saying this sentence calmly, emotional interference may already be present. Awareness also protects against inactivity driven by fear. Sometimes the distortion is hesitation. After a series of losses, even valid setups feel threatening. The trader delays entry, then watches the move unfold without participation. Frustration follows. The pattern repeats. Recognizing fear early allows you to separate valid caution from emotional avoidance. Emotional control is not suppression. Suppression pushes emotion beneath awareness where it influences behavior indirectly. Recognition brings it into light, where it loses intensity. Develop this skill deliberately. During your next trading session, set a timer to check in with yourself every 30 minutes. When it signals, look away from the chart briefly and label your emotional state in one word: calm, focused, impatient, confident, tired. Record it quickly in a notebook. At the end of the session, review the pattern and compare it to your trade quality. You will begin to see correlation between emotional state and execution consistency. Over time, you will detect drift earlier. The whisper becomes audible before it becomes a command. The goal is not emotional neutrality at all times. The goal is emotional awareness before action. When awareness leads, impulse follows less often. Markets will always provoke reaction. News spikes, sudden reversals, missed entries, emotional triggers are constant. Your advantage grows when you recognize the internal shift before it touches the order button. Awareness creates space. In that space, discipline operates. Professional traders are not emotionless. They are observant. They feel the surge, notice it, and decide whether to act from structure or from impulse. Control begins the moment you can name what you feel without letting it define what you do. Uncertainty feels chaotic until it is contained by structure. In trading, structure begins with risk. Not prediction. Not indicators. Risk. Most emotional instability in markets can be traced back to one problem: exposure that exceeds psychological tolerance. When the potential loss feels too large, fear intensifies. When the potential gain feels oversized, greed expands. Both distort execution. A risk unit is a predefined, fixed amount of capital exposed per trade. It is not adjusted impulsively. It is not increased because you feel confident. It is not decreased because you feel afraid. It is calculated in advance and applied consistently. Risk becomes a psychological anchor. When exposure is defined before entry, emotional turbulence decreases. You already know the worst-case outcome within acceptable limits. There is nothing to negotiate mid-trade. Many traders reverse this order. They enter first, then decide how much they are willing to lose. This creates internal conflict. As price moves against them, they adjust stops. They widen risk. They rationalize. The absence of structure invites fear-based decision-making. Consider a trader who risks 5% of his account on a single trade because he feels certain about a setup. As soon as price fluctuates against him, his attention narrows. Every tick feels threatening. He watches unrealized loss expand rapidly. Instead of evaluating the setup objectively, he focuses on protecting capital emotionally. He exits early, only to see the trade recover without him. Frustration follows. The issue was not analysis. It was oversized exposure. Now imagine the same trader risking 1% per trade, consistently. The financial impact of a single loss is contained. When price moves against him, discomfort exists, but it does not overwhelm reasoning. He allows the trade to reach its predefined stop without interference. Emotional stability increases because risk remains within tolerance. The purpose of a risk unit is not to eliminate loss. Loss is unavoidable. The purpose is to eliminate emotional escalation. When risk per trade is fixed, your nervous system begins to normalize drawdowns. A losing streak becomes data rather than disaster. Because each loss is measured, cumulative impact remains manageable. Risk discipline also prevents overconfidence. During winning streaks, traders often increase position size impulsively, believing momentum is on their side. Without fixed exposure, a single reversal can erase multiple gains. Emotional whiplash follows. A professional mindset treats risk as constant even when performance fluctuates. Confidence does not justify larger exposure. Frustration does not justify revenge sizing. Risk clarity improves decision quality before entry. If you cannot define exactly where your trade idea is invalidated, you should not be in the trade. Undefined exits invite emotional negotiation later. Another benefit of consistent risk sizing is statistical clarity. When each trade carries similar exposure, performance patterns become easier to evaluate. Emotional noise decreases because outcomes are proportionate. To implement this anchor, determine a fixed percentage of capital that represents your risk unit. This percentage should be small enough that a series of losses does not threaten account survival or psychological stability. Once defined, commit to applying it without exception. Before entering any trade, calculate position size so that your predefined stop corresponds precisely to that risk unit. If position size becomes impractical due to volatility, skip the trade. Structure must take priority over participation. During trading, remind yourself that your only job is to execute within the defined risk. The outcome of any single trade is irrelevant. Your responsibility is containment. There is freedom in limited risk. When exposure is controlled, you can think clearly. You no longer hope or fear intensely. You execute. Markets reward consistency over intensity. A trader who survives volatility with stable risk remains in the game long enough for statistical edge to play out. Emotional control strengthens when uncertainty is framed by boundaries. Risk boundaries create psychological safety. Within those boundaries, discipline thrives. You cannot control market movement. You can control how much of your capital is vulnerable to it. That control changes everything. Risk is not merely a financial concept. It is emotional architecture. When built correctly, it stabilizes your internal state and protects your long-term performance. Anchor your decisions in predefined exposure. Let structure absorb volatility so your mind does not have to. The market does not reward certainty. It rewards discipline within uncertainty. Many traders approach charts with a hidden assumption: this trade must work. They analyze until they feel convinced. They search for confirmation that removes doubt. When doubt remains, they hesitate. When they feel certain, they overcommit. Professional thinking replaces certainty with probability. Expectancy thinking is evaluating performance based on statistical edge over time rather than individual outcomes. It separates the quality of the decision from the result of the trade. A single win proves nothing. A single loss proves nothing. Only a series of trades executed consistently reveals edge. This shift transforms emotional response. When you believe each trade must succeed, loss feels personal. It feels like failure. When you understand that even strong setups fail regularly, loss becomes part of distribution. Consider a trader whose system historically wins 55% of the time with a favorable risk-to-reward ratio. That means nearly half of all trades will lose. Yet, after 2 losses in a row, doubt creeps in. He begins to question the system. He skips the next valid setup. That setup wins. Frustration rises. He then enters the following trade impulsively, without full confirmation, hoping to catch momentum. That trade loses. Emotional instability grows not because the system failed, but because probability was misunderstood. Now imagine the same trader fully internalizing expectancy. Before the session begins, he reminds himself that losses are mathematically inevitable. He focuses only on whether each trade meets criteria and respects the predefined risk unit. After 2 losses, he feels discomfort, but not panic. He recognizes the sequence as statistically normal. When the next valid setup appears, he executes without hesitation. Over time, the edge materializes across many trades. Probability thinking dissolves attachment to individual outcomes. It also reduces overconfidence after wins. A profitable trade does not confirm skill in isolation. It may simply be part of random distribution. When you evaluate yourself based on process adherence rather than outcome, emotional spikes flatten. Another key shift is abandoning prediction language. Instead of saying, "This will go up," the professional frame becomes, "If these conditions hold, probability favors upside." This subtle change in language influences perception. It leaves room for uncertainty. Expectancy thinking requires data. Without records, probability remains abstract. Professionals track trades meticulously, not to relive wins or losses, but to understand distribution. Over dozens or hundreds of trades, patterns emerge. Emotional reactions lose authority when confronted with statistics. There is also freedom in knowing that perfection is unnecessary. A system with modest edge can generate strong returns if executed consistently. Emotional volatility often destroys this consistency more than flawed analysis. To train this mindset, review your last 20 trades. Calculate win rate and average reward relative to risk. Observe the natural clustering of wins and losses. Notice that sequences of losses occur even within profitable systems. Write down the maximum historical losing streak. Keep that number visible during trading sessions. When a streak begins, compare it to historical data before altering behavior. This practice grounds emotion in evidence. Another exercise strengthens detachment. After each trade, instead of labeling it good or bad based on profit, label it as disciplined or undisciplined based on adherence to rules. Over time, this reframes your identity from outcome chaser to process executor. Markets are probabilistic environments. Expecting certainty creates emotional fragility. Embracing probability creates resilience. The professional trader does not seek to be right every time. The objective is to execute edge repeatedly without interference. When you think in terms of distribution rather than prediction, fear decreases. Greed softens. Urgency fades. Individual trades lose emotional weight. Sequences matter. Consistency matters. Probability thinking transforms trading from emotional roller coaster into structured performance. It aligns your expectations with reality. Uncertainty remains, but it no longer destabilizes you. You operate within it calmly, knowing that edge unfolds over time, not in a single moment. Uncertainty cannot be eliminated. It must be organized. In trading, organization comes from structure that operates even when emotion rises. Analysis may generate ideas, but execution requires discipline. Without structure, hesitation and impulse compete for control. An execution protocol is a rule-based checklist guiding trade entry and exit. It exists to protect you from yourself. When clearly defined and consistently followed, it reduces subjective interpretation in moments of pressure. Most emotional mistakes occur between signal and action. The setup appears. Adrenaline rises. Doubt whispers. Excitement pushes. In that narrow window, deviation is common. The protocol closes that window. A professional does not rely on memory during live markets. Criteria are written, reviewed, and confirmed before entry. If a trade does not meet the checklist, it is not taken. If it does, it is executed without hesitation. Consider a trader who identifies breakouts as his primary strategy. Without a strict protocol, he begins entering before confirmation because he fears missing the move. Sometimes it works, reinforcing the behavior. Other times it fails, creating inconsistency. Frustration builds because results feel random. Now imagine the same trader implementing a structured protocol. The checklist includes specific conditions, defined price level, volume expansion above average, alignment with higher time frame direction, and acceptable risk relative to his risk unit. Before placing an order, he verifies each condition deliberately. If one element is missing, he waits. At first, this feels restrictive. He watches some moves unfold without him. Over time, however, he notices improved consistency. Fewer impulsive entries. Fewer emotional exits. Performance stabilizes because behavior stabilizes. Pre-commitment is central to effective protocols. Decisions about entry criteria, stop placement, and profit targets must be defined before exposure. Once in the trade, the mind seeks justification to change rules. Pre-commitment prevents mid-trade negotiation. There is also value in defining when not to trade. Market conditions vary. If volatility is too low, if liquidity is thin, or if your emotional baseline is unstable, the protocol should permit inactivity. Professional discipline includes strategic restraint. Checklists reduce cognitive load. Instead of analyzing endlessly, you measure the situation against clear standards. This frees mental energy and reduces anxiety. Deviation often begins subtly. You may adjust a stop slightly because this one looks strong. You may move a target because momentum feels intense. Each adjustment appears minor. Over time, these small changes erode consistency. The protocol exists to prevent gradual drift. To strengthen adherence, physically keep your execution protocol visible during trading sessions. Before every trade, read each criterion aloud or silently with full attention. If any element is uncertain, pause. After each session, review every trade and mark whether it followed the protocol precisely. Do not judge outcome. Judge compliance. Patterns of deviation will become visible quickly. Another powerful reinforcement is limiting discretionary overrides. If you choose to break your protocol, document the reason in writing before executing. This additional step often reveals whether the impulse is rational or emotional. Structure does not remove uncertainty from markets. It removes unnecessary uncertainty from your behavior. Professionals understand that edge is fragile. It depends on repeated execution under similar conditions. Every deviation alters that distribution. Clarity of rules creates calm under pressure. When volatility increases, You do not invent new tactics mid-session. You execute what has been tested. The goal is not mechanical rigidity. It is disciplined consistency. Refinement of strategy occurs outside live markets through structured review, not during emotional exposure. Execution protocols transform trading from reactive guessing into repeatable performance. When your actions are governed by predefined criteria rather than shifting emotion, confidence grows naturally. Not because every trade wins, but because every trade aligns with structure. In uncertain environments, structure is stability. Stability is strength. Build your protocol. Respect it. Let it carry you through moments when emotion would otherwise lead. Markets do not move randomly in appearance. They move in waves of pressure. Price expands, contracts, accelerates, stalls. Volume increases, then disappears. News hits, volatility spikes, liquidity thins. Many traders are pulled emotionally into these shifts. Professionals observe them without absorption. Reading market pressure means interpreting movement objectively while avoiding emotional contagion. When volatility rises, the crowd often reacts with urgency. Urgency spreads quickly through screens and headlines. Without discipline, your internal state begins to mirror the market's speed. A volatility signal is objective price expansion indicating increased uncertainty. It is not inherently bullish or bearish. It is information about intensity. Intensity requires adjustment, not panic. Amateurs often equate movement with opportunity. The faster price moves, the stronger the urge to participate. Fear of missing out amplifies when candles expand rapidly. Entries become impulsive. Stops widen. Plans dissolve. Professionals treat volatility as a condition to evaluate, not a command to act. Imagine a trader observing a major currency pair just after unexpected economic data is released. Price surges violently in one direction, retraces sharply, then accelerates again. Social media explodes with commentary. Many traders jump in mid-move, hoping to capture momentum. Slippage increases. Spreads widen. Stops are triggered quickly due to erratic swings. A disciplined trader approaches differently. He recognizes the volatility signal immediately, expansion beyond average range within minutes. Instead of entering, he steps back. He reduces position size temporarily or waits for structure to reform. He understands that liquidity during news events can distort price behavior. While others chase, he observes. Once volatility contracts and clearer structure appears, he evaluates setups under normal criteria. The emotional storm passes without pulling him off balance. Reading pressure also involves recognizing crowd behavior. Rapid vertical movement often reflects imbalance between buyers and sellers, but it can also signal exhaustion. Volume spikes may indicate participation surge, yet without context they reveal little about direction. The key is detachment. When you begin to feel urgency simply because price is moving fast, pause. Ask whether your execution protocol is being met or whether excitement is influencing perception. Market pressure can also compress into tight consolidation. Low volatility environments test patience differently. Boredom can push traders into suboptimal trades simply to feel engaged. Recognizing that lack of movement is also information prevents unnecessary exposure. Professional traders adjust expectations according to conditions. They may scale down risk during unstable sessions or reduce trade frequency during choppy markets. Adaptation is deliberate, not reactive. One practical exercise strengthens objective reading. At the beginning of each session, calculate the average daily range or recent volatility measure of your instrument. When price exceeds typical expansion early, label it clearly as high volatility condition. When price remains compressed below average movement, label it as low volatility condition. This simple categorization prevents emotional misinterpretation. You respond to environment rather than react to sensation. Another discipline involves stepping away briefly during extreme spikes. Even a 2-minute pause can prevent impulsive entries driven by adrenaline. Markets often offer secondary opportunities once initial chaos subsides. Pressure in markets is constant but variable in intensity. Your internal state does not need to fluctuate with it. Emotional contagion is subtle. Fast markets create fast thinking. Slow markets create restless thinking. Awareness allows you to counterbalance both. Objective observation requires distance. When you watch price as information rather than invitation, clarity increases. Markets test patience in two directions: too much movement and too little. Stability comes from interpreting both as conditions to navigate, not signals to react emotionally. When volatility expands, breathe and measure. When it contracts, remain selective. Let structure, not speed, guide your actions. Professional performance is not about chasing motion. It is about responding appropriately to pressure without becoming part of it. The market may surge or stall. Your discipline remains steady. In trading, action feels productive. Inactivity feels uncomfortable. Yet many of the most costly mistakes occur not from bad analysis, but from the inability to wait. The urge to participate can be stronger than the logic to abstain. Mastery requires strengthening what can be called your patience threshold. Patience threshold is the ability to remain inactive until predefined criteria are fully met. It is not passive hesitation. It is controlled restraint aligned with your execution protocol and probability edge. Markets provide constant stimulation. Candles form every minute. Prices tick continuously. News headlines appear throughout the day. This flow creates psychological pressure to engage. Sitting still while opportunity appears to pass can feel like failure. Professional traders understand that selective participation is strength. They know that edge exists only under specific conditions. Entering outside those conditions dilutes performance. Imagine a trader who specializes in breakout setups during strong trending sessions. On a particular day, the market opens with choppy, sideways movement. Small false breakouts occur repeatedly. He feels restless watching minor moves unfold. Several times, he considers entering early, convincing himself that the next push might hold. Instead, he reviews his criteria. The broader structure does not support continuation. Volume is inconsistent. He stays flat. Hours later, a clear directional move forms with alignment across time frames. He enters decisively, managing risk within his defined risk unit. The trade performs well. The difference was not predictive skill. It was disciplined waiting. Impatience often disguises itself as intuition. A subtle internal voice says, "This looks close enough." That phrase signals drift. Close enough is rarely consistent with structured trading. Boredom is another trigger. During low volatility periods, the absence of movement can create psychological discomfort. The mind seeks stimulation. Entering marginal trades relieves boredom temporarily, but introduces unnecessary risk. Strengthening patience requires reframing inactivity as active discipline. When you are not trading, you are preserving capital and psychological stability. You are protecting your edge for conditions that justify exposure. There is also emotional safety in knowing that missed trades are part of the process. You will not capture every move. Professionals accept this. They focus on capturing structured opportunity, not all opportunity. One effective drill is implementing a minimum confirmation rule. For example, require 2 independent criteria to align before any entry. If one is missing, you wait. Even if price moves without you, the rule stands. After the session, review the trades you skipped and evaluate objectively whether they truly met your standards. Over time, this builds confidence in restraint. Another practice involves limiting the number of trades per session. Define a maximum threshold aligned with your strategy. When that number is reached, stop trading, regardless of emotion. This constraint prevents overactivity driven by impatience. Patience also protects emotional balance. Frequent, low-quality trades create a roller coaster of minor wins and losses that erode focus. Fewer, high-quality trades preserve mental clarity. High-level performance in trading often involves long periods of waiting interrupted by brief, decisive execution. This rhythm contrasts sharply with the constant activity many beginners expect. Your patience threshold increases through repetition. Each time you choose not to enter a marginal setup, you strengthen discipline. Each time you resist boredom, you reinforce identity. Waiting is not weakness. It is strategic filtration. When the right conditions appear, action becomes easier because emotional noise is reduced. There is no internal debate. Criteria are met. Risk is defined. Execution follows. Markets will continue moving whether you participate or not. Your responsibility is not to trade constantly. It is to trade correctly. Discipline in waiting sharpens discipline in acting. When you master inactivity, your actions become deliberate rather than reactive. The ability to sit still while others chase is a professional advantage. Over time, that restraint translates directly into consistency. Let the market prove itself before you commit. Patience preserves capital, clarity, and confidence. Loss is not the problem. Reaction to loss is. Every trading strategy, no matter how refined, includes losing trades. The difference between amateur and professional performance lies in how those losses are absorbed. Without structure, one loss can trigger a cascade of emotional decisions that cause far more damage than the initial trade. Loss containment is the structured response to losing trades that prevents escalation. It is the discipline of accepting predefined risk without altering behavior in an attempt to recover quickly. The most dangerous pattern in trading is revenge execution. A loss creates discomfort. Discomfort demands relief. The fastest perceived relief is a new trade. That trade is rarely taken from calm analysis. It is taken from emotional urgency. Imagine a trader who executes a valid setup according to his execution protocol. The trade hits the predefined stop. The loss is within his risk unit. Objectively, nothing went wrong. Yet internally, frustration builds. He begins scanning aggressively, lowering criteria slightly. A marginal setup appears. He enters with slightly larger size, rationalizing that the market now owes him a win. That trade loses as well. Emotional pressure intensifies. By the third trade, discipline has collapsed entirely. What began as one controlled loss becomes a day of significant damage. The market did not change. Emotional drift did. Professional traders treat each loss as a closed event. Once the stop is hit, the trade is over. There is no negotiation, no reinterpretation. The focus returns to process, not outcome. Loss also triggers self-doubt. After several consecutive losing trades, even within normal statistical range, confidence may weaken. Doubt can lead to hesitation on the next valid setup, which disrupts expectancy. Avoiding good trades out of fear can be as damaging as overtrading out of anger. Containment requires predefined rules beyond position sizing. For example, establish a daily loss limit measured in risk units. If reached, trading stops for the session without exception. This boundary protects psychological capital and prevents emotional spirals. Another critical element is post-loss ritual. After a stopped trade, step away briefly from the screen. Stand up. Breathe slowly. Review whether the trade followed your protocol. If it did, label it as a disciplined loss. That phrase reframes the event as successful execution rather than failure. Consider a trader who experiences 4 losses in a row, all within plan. Instead of escalating, he pauses after the 4th trade because it reaches his daily threshold. He closes the platform and reviews the setups later that evening. He confirms that each trade met criteria. The losing sequence falls within historical drawdown patterns of his strategy. By stopping, he preserves capital and mental clarity. The next session, he returns balanced. Within days, distribution normalizes and wins resume. Containment prevented emotional damage from amplifying natural variance. Loss is information. It reveals whether conditions are shifting or whether distribution is unfolding normally. Emotional reaction obscures that information. Another practice strengthens stability, tracking maximum historical losing streaks. When you know your system has previously experienced 5 consecutive losses before returning to profitability, encountering 3 losses feels less threatening. Data reduces fear. Avoid analyzing markets aggressively immediately after a loss. Intense chart scanning can fuel impulsive entries. Instead, create a short cooling period, even if only 5 minutes. During that time, focus on breathing and physical reset rather than price action. Language also shapes perception. Replace thoughts like, "I was wrong," with, "the setup did not resolve as expected." This maintains objectivity and reduces ego involvement. Trading without losses is impossible. Trading without escalation is achievable. Loss containment protects both capital and confidence. It ensures that one trade remains one trade, not the beginning of emotional collapse. When you accept predefined risk fully before entry, exit becomes procedural rather than dramatic. The stop is not punishment. It is structure working as designed. Professional traders do not avoid loss. They manage response. Consistency over time depends less on avoiding losing trades and more on preventing losing reactions. Control your behavior after loss, and you control the trajectory of your performance. Loss tests discipline. Profit tests it even more. When trades are winning, confidence expands. The mind begins to associate recent success with skill, timing, even intuition. Energy rises. Focus sharpens. Yet beneath that momentum, risk quietly increases if not contained. Profit discipline is maintaining consistent sizing, rules, and structure during winning periods. It is the refusal to let success distort exposure or criteria. Greed rarely announces itself directly. It appears as opportunity. This one looks strong. I should size up while I'm in sync. The market is moving perfectly today. These thoughts feel rational because they are supported by recent wins. Imagine a trader who has just closed 3 profitable trades in a row. Each followed his execution protocol. Confidence builds. On the 4th setup, which meets most but not all of his criteria, he decides to enter slightly earlier than usual. He also increases position size beyond his standard risk unit because he feels aligned with the market. The trade initially moves in his favor, reinforcing the decision. Instead of taking partial profit at predefined levels, he holds for more, expecting continuation. The market reverses sharply. The oversized position erases the day's gains in minutes. What undermined him was not a flawed strategy. It was undisciplined expansion driven by success. Winning streaks alter perception. Risk appears smaller. Probability feels higher. Emotional comfort increases tolerance for exposure. Without conscious control, sizing creeps upward and standards loosen. Professional traders maintain identical risk parameters regardless of recent performance. One win does not justify larger exposure. 10 wins do not guarantee the 11th. Distribution remains unpredictable in the short term. Another common distortion during profitable periods is target extension. A trader reaches a predefined profit level but chooses to hold longer, convinced the move will expand further. Sometimes it does. That reinforces deviation. Over time, inconsistency emerges. What was once a structured exit becomes subjective. Greed also expresses itself through overtrading during strong sessions. After early gains, some traders continue engaging the market aggressively, attempting to maximize the day. Fatigue increases. Criteria blur. Late session losses give back profits earned earlier with discipline. Profit discipline requires emotional neutrality toward gains. A profitable trade is simply one data point within expectancy. It is not validation of superiority. One effective practice is locking in structure during positive runs. If you experience multiple consecutive wins, consciously review your rules before the next trade. Confirm that risk unit remains unchanged. Reaffirm entry and exit criteria in writing. This interrupts overconfidence before it alters behavior. Another method is implementing a daily profit threshold. When reached, reduce position size or stop trading entirely. This prevents emotional escalation driven by euphoria. Consider a trader who defines a target of 3 risk units in profit per day. On a strong session, he reaches that threshold by midday. Instead of continuing at full size, he either stops or scales down significantly. He protects psychological stability and avoids unnecessary exposure. Over time, this consistency compounds. Profit discipline also strengthens long-term mindset. When gains are treated as routine rather than exceptional, ego involvement decreases. You become less attached to daily performance and more committed to sustained execution. Greed thrives in moments of emotional expansion. Awareness of physical cues helps contain it. Rapid speech, increased screen focus, and impulsive idea generation often signal rising euphoria. When detected, pause intentionally. Breathe. Reconnect with structure. Markets reward those who survive their own success. Many accounts grow quickly and then collapse because early gains created overconfidence. Consistency across both loss and profit separates professionals from reactive traders. Emotional stability must remain symmetrical. Calm after loss. Calm after win. The objective is not to suppress satisfaction. It is to prevent satisfaction from altering discipline. Profit is the result of process. Protect the process first. When structure remains constant during winning streaks, equity curves grow steadily rather than violently. Stability builds confidence grounded in discipline rather than momentum. Mastering emotional control means handling gains with the same restraint as losses. Success, when unmanaged, can be as dangerous as failure. Stay measured. Let consistency, not excitement, define your growth. Volatility compresses time. In fast markets, seconds feel shorter. Price accelerates. Spreads widen. News hits unexpectedly. The nervous system reacts instantly. Heart rate increases. Focus narrows. Decisions feel urgent. This is where emotional control is tested most directly. Pressure containment is emotional regulation during rapid market movement. It is the ability to maintain structured execution when speed and uncertainty increase simultaneously. High volatility conditions create two primary dangers: impulsive entry and premature exit. In both cases, fear of missing out or fear of loss overrides protocol. When price surges rapidly, many traders feel compelled to act immediately. They believe delay equals missed opportunity. Entries are taken far from ideal levels. Stops are placed loosely or not at all. The trade becomes a reaction to speed rather than a decision grounded in structure. On the opposite side, when already in a position during volatility, emotional intensity may trigger early exits. A sharp pullback within a larger move feels threatening. Traders close profitable positions prematurely, only to watch the trend resume without them. Professionals respond differently. Imagine a trader holding a position when unexpected economic news causes a sudden spike in volatility. Price moves aggressively in his favor at first, then retraces sharply within seconds. Instead of reacting to each tick, he references his predefined exit levels. His stop and target were determined before entry. He monitors price but does not interfere unless those levels are reached. His breathing slows deliberately. He reduces physical movement to prevent impulsive action. When price stabilizes and resumes direction, the trade continues according to plan. The difference was not prediction. It was containment. Containment begins before volatility appears. If you know that major news events are scheduled, decide in advance whether you will trade through them or remain flat. Predecision removes emotional debate during the event. Another powerful tool is tempo control. During rapid movement, consciously slow your physical actions. Move the mouse deliberately. Speak internally at a slower pace. These small adjustments counteract the body's instinct to rush. Visual simplification also helps. When volatility expands, excessive indicators or multiple time frames can overwhelm perception. Focus on the key levels defined in your plan. Reduce screen clutter if necessary. There is also value in temporarily reducing size during highly volatile sessions. Smaller exposure lowers emotional intensity, making disciplined execution easier. Risk remains aligned with structure rather than sensation. Adrenaline can feel productive. It sharpens attention. Yet unchecked adrenaline distorts judgment. Professionals treat heightened intensity as a signal to stabilize, not accelerate. Training for volatility involves simulation and review. Study past high-impact sessions. Observe how price behaved. Note where emotional mistakes occurred. Build rules specific to volatile conditions, such as wider predefined stops or strict avoidance of initial spikes. A practical exercise strengthens composure. During your next volatile session, when you feel urgency rising, remove your hand from the mouse for 5 full seconds. Breathe slowly. Reconfirm your plan before any action. This short interruption often prevents impulsive decisions. High volatility markets are not inherently dangerous. Emotional reactivity within them is. Pressure containment ensures that your behavior does not amplify market intensity. You remain steady while price fluctuates. Professional traders are not immune to adrenaline. They simply refuse to let it dictate execution. Fast movement does not require fast thinking. It requires clear thinking. When volatility expands, anchor yourself in structure. Predefined levels. Defined risk. Confirmed criteria. Let the market move quickly if it must. Your discipline moves at its own pace. Control your tempo, and you control your response. In rapid conditions, that control is your edge. Trading is often seen as purely analytical. Charts, numbers, probabilities. Yet performance at the screen is deeply physical. Your posture, breathing, and environment influence your decisions more than you may realize. When the body is tense, the mind follows. When the environment is chaotic, focus fractures. Professional performance requires deliberate control over both. Trading presence is the calm physical and mental state maintained while executing trades. It is the integration of posture, breath, attention, and emotional awareness into a stable operating condition. Many traders sit hunched forward, eyes locked on every tick, shoulders tight, breathing shallow. This posture signals threat to the nervous system. The body prepares for reaction. Decision speed increases, often at the expense of clarity. Professionals cultivate a different physical stance. Upright but relaxed. Shoulders steady. Breathing slow and even. Movements deliberate rather than frantic. These adjustments may appear small, yet they influence cognitive control significantly. Imagine a trader midway through a session. The market is active but not extreme. He notices tension building in his neck and jaw after several trades. Instead of ignoring it, he leans back slightly, places both feet flat on the ground, and takes 5 slow breaths. He widens his visual focus, looking away from the chart briefly to reset his eyes. When he returns to the screen, perception feels clearer. He avoids a marginal setup he might have taken while tense. A few minutes later, a higher quality opportunity appears. The reset preserved discipline. Physical awareness protects psychological capital. Your trading environment also shapes performance. Excessive notifications, background noise, or multiple open applications fragment attention. Fragmented attention increases impulsivity. A professional workspace minimizes distraction. The screen displays only what is necessary. Phones are silenced. External stimulation is reduced. Lighting and screen brightness matter as well. Harsh light increases fatigue. Dim lighting strains focus. Balanced conditions support sustained concentration. Routine further strengthens presence. Beginning each session at a consistent time, reviewing the same checklist, and sitting in the same organized space signals readiness to the brain. Consistency builds mental stability. Another element of trading presence is controlled speech, even if only internal. When self-talk becomes critical or frantic, execution deteriorates. Replace reactive language with neutral phrasing. Instead of "I can't miss this," shift to "Does this meet my criteria?" Instead of "This is going wrong," shift to "Price is testing the level." Language influences emotional tone. Breaks are also strategic. Extended screen time reduces clarity. Professionals step away intentionally after defined intervals or after intense sequences of trades. A brief walk or stretch resets attention and prevents cognitive overload. Presence must be maintained even during profitable sessions. Excitement can lead to leaning forward, increased screen fixation, and faster clicking. These physical cues precede emotional expansion. Noticing them early prevents drift. A practical exercise reinforces this discipline. Before each session, adjust your chair and screen to an upright, neutral posture. Place both feet grounded. Take 10 slow breaths before opening charts. During trading, set a quiet reminder every hour to scan your body for tension. If detected, reset immediately. At the end of the session, Evaluate not only your trades but also your physical steadiness. Professional trading is endurance performance. It requires sustained clarity over hours, sometimes days. Physical stability supports mental precision. The market may fluctuate rapidly. Your body does not need to mirror it. When posture is controlled, breathing steady, and environment disciplined, your emotional baseline becomes easier to maintain. Cognitive drift decreases. Decisions feel less urgent and more deliberate. Trading presence transforms execution from reactive clicking into structured performance. Calm body, clear mind, stable decisions. The screen is where performance happens. How you sit, breathe, and focus while facing it determines whether emotion or discipline takes control. Master your physical state, and your mental state follows. A single trade proves nothing. A single week proves nothing. Even a single profitable month proves very little without context. What builds confidence in trading is not outcome alone. It is repetition of structured behavior over time. This is process trust. Process trust is confidence built from consistent adherence to rules rather than emotional reaction to results. It shifts identity from outcome chaser to disciplined executor. Many traders evaluate themselves based on daily profit and loss. Green days feel successful. Red days feel like failure. This emotional attachment to short-term outcome destabilizes performance. When profit becomes validation, discipline becomes secondary. Professional thinking reverses the hierarchy. The first question after a trade is not, "Did I make money?" It is, "Did I follow my plan?" If the answer is yes, confidence increases regardless of outcome. If the answer is no, adjustment is required regardless of profit. Imagine a trader who executes 5 trades in a session. 3 lose, 2 win. Net result is slightly negative. At first glance, the day appears unsuccessful. However, each trade followed the execution protocol precisely. Risk was controlled. Entries were valid. Exits respected predefined levels. From a process perspective, the day was a success. Distribution simply unfolded unfavorably. Now imagine the opposite scenario. A trader ends the day with strong profit, but 2 of the trades were impulsive deviations from his rules. Emotionally, he feels rewarded. Yet the behavior underlying those gains is unstable. Without correction, that instability will surface later. Process trust grows when discipline is reinforced independently of outcome. Tracking becomes essential. Without records, you rely on memory, and memory is biased by emotion. A structured journal that documents entry criteria, emotional state, adherence to risk, and outcome provides objective feedback. Over time, patterns become visible. You begin to see that disciplined trades, even during losing streaks, maintain expectancy. Undisciplined trades introduce volatility into performance. Process trust reduces anxiety before sessions. When you know that your responsibility is execution rather than prediction, pressure decreases. You are no longer trying to control the market. You are controlling yourself. It also stabilizes identity during drawdowns. Instead of questioning your competence after a series of losses, you review your data. If rules were followed and historical drawdown parameters remain intact, you continue. Emotional turbulence loses influence because evidence provides context. Another benefit of process trust is consistency in behavior after wins. Because profit is not the primary measure of success, there is less temptation to alter risk or criteria impulsively. To strengthen this mindset, implement a post-session scoring system. For each trade, assign a simple rating: fully compliant, partially compliant, or non-compliant. Ignore financial result in this scoring. At the end of the week, calculate the percentage of fully compliant trades. Make this your primary performance metric. Aim to improve compliance over time. Additionally, review cumulative data monthly rather than obsessing over daily fluctuation. Evaluate expectancy, drawdown, and adherence trends. This longer horizon reinforces probabilistic thinking. Confidence built on outcome is fragile. One losing streak can destroy it. Confidence built on process is durable. It rests on behavior you can control. Markets are unpredictable in the short term. Your execution does not need to be. When you trust your process, hesitation decreases. Overtrading decreases. Emotional reaction decreases. You become steady because your benchmark is internal consistency, not external fluctuation. Professional traders operate with quiet assurance not because they win every trade, but because they know what they will do in every scenario. Process first. Outcome second. When discipline becomes the measure of success, emotional volatility loses its grip. Trust your structure. Execute it repeatedly. Over time, results align with consistency. No trading strategy remains perfectly effective forever. Market conditions shift. Volatility expands and contracts. Liquidity patterns evolve. What worked cleanly in one environment may struggle in another. The challenge is not avoiding change. It is adapting without emotional overreaction. Adaptive calibration is data-driven refinement of strategy parameters rather than impulsive overhaul. It preserves core structure while adjusting to measurable shifts in conditions. Many traders respond to drawdowns by abandoning their system entirely. A few losses occur, confidence drops, and they search for a new indicator or method. This cycle repeats endlessly. Each switch resets statistical edge before it has time to unfold. Professionals distinguish between normal distribution and structural change. A temporary losing streak within historical range does not require modification. It requires continued, disciplined execution. Structural change, however, is indicated by consistent deviation from historical performance metrics over a meaningful sample size. Imagine a trader whose strategy performs best in trending environments. Over several months, markets become range-bound and choppy. His win rate declines steadily beyond historical norms. Instead of immediately discarding his approach, he reviews data objectively. He analyzes volatility measures, average range, and breakout follow-through statistics. He discovers that trend continuation probability has decreased significantly. Rather than abandoning his core strategy, he adjusts parameters. He reduces trade frequency, tightens entry confirmation, and decreases risk units slightly during low volatility periods. As conditions evolve again, performance stabilizes. The adjustment was measured, not emotional. Adaptive calibration requires detachment from ego. If you identify too closely with a specific setup, changing it may feel like personal failure. Viewing strategy as a tool rather than identity makes refinement easier. Timing is critical. Adjust too quickly and you disrupt statistical validity. Adjust too slowly and you accumulate unnecessary losses. Data determines timing, not frustration. Tracking performance metrics consistently is essential. Win rate, average reward to risk, maximum drawdown, and frequency of setups provide objective signals. If multiple metrics deteriorate simultaneously over a significant sample size, recalibration may be warranted. Another danger during adaptation is over-optimization. After a rough period, traders often tweak numerous variables at once. This creates a system fitted to recent data rather than robust across environments. Professionals make incremental changes and test them over time. One practical method is isolating a single variable for adjustment. For example, if volatility has compressed, you might extend holding periods slightly or refine entry triggers. Implement that change for a defined sample of trades before evaluating impact. Avoid stacking multiple changes simultaneously. Emotional awareness remains critical during calibration. If your motivation for change is frustration or urgency, pause. Review data calmly. Confirm whether the deviation exceeds historical norms. Only then proceed. Adaptive calibration also includes stepping back temporarily when clarity fades. A short break from live trading can restore perspective and prevent reactive overhauls. Consider a trader who experiences a challenging month. Instead of rewriting his strategy overnight, he reviews the last 100 trades. He notices that performance during specific time windows deteriorated while other periods remained stable. Rather than abandoning the system, he narrows trading hours. This targeted refinement restores expectancy without disrupting core methodology. The goal of adaptation is alignment with conditions, not reinvention driven by emotion. Professional traders understand that markets cycle. Strategies perform differently across phases. Calm analysis distinguishes temporary discomfort from genuine structural shift. Flexibility strengthens longevity. Rigidity invites stagnation. Impulsiveness invites chaos. Your foundation remains constant: risk discipline, execution protocol, and probability thinking. Calibration adjusts surface parameters while preserving these pillars. When adaptation is guided by evidence rather than fear, confidence remains intact. You are refining, not reacting. Sustained success in trading belongs to those who evolve deliberately. The market changes gradually and sometimes suddenly. Your response must be measured, data-based, and controlled. Adapt when necessary, but adapt with discipline. That balance preserves both edge and emotional stability. Capital is not only financial. Every trading session draws from a deeper reserve: focus, discipline, resilience, clarity. When those reserves deplete, performance deteriorates even if strategy remains sound. Protecting these reserves is essential for long-term consistency. Psychological capital is your store of mental energy, emotional stability, and cognitive sharpness. Unlike money, it is invisible. Yet once exhausted, its absence becomes obvious. Many traders ignore this dimension. They focus on charts for hours without breaks. They trade through fatigue. They remain glued to screens after losses. Over time, attention fragments. Decision quality declines. Small mistakes increase. Fatigue disguises itself as urgency. When tired, the brain seeks stimulation. Fast markets appear more attractive. Risk tolerance shifts subtly. Emotional reactions intensify. Sustainable performance requires managing energy deliberately. Imagine a trader who has been profitable for several weeks but has also increased his screen time significantly. He begins waking early to monitor overseas markets and stays late reviewing charts. Sleep decreases. Initially, productivity feels high. Then minor execution errors appear. Stops are miscalculated. Entries are slightly premature. Irritation increases during small drawdowns. Performance slips gradually, not because strategy failed, but because psychological capital was drained. Professional traders respect recovery cycles. They define session duration limits. They schedule breaks away from screens. They protect sleep as a performance asset. They understand that mental clarity compounds just as financial capital does. Energy management also includes emotional recovery after intense sessions. High volatility days, even when profitable, can leave the nervous system overstimulated. Continuing to trade immediately the next day without reset increases risk of impulsive behavior. Another dimension of psychological capital is exposure control. Watching markets continuously, even when not trading, can create unnecessary cognitive load. Selective engagement preserves focus for when it matters. Long-term consistency depends on rhythm. Periods of execution balanced with periods of review and rest. One effective discipline is setting a maximum number of focused trading hours per day. Once reached, analysis stops. Journaling and light review may continue, but live exposure ends. This boundary prevents overextension. Physical health supports psychological reserves. Regular exercise, hydration, and balanced nutrition stabilize mood and concentration. Neglecting the body eventually disrupts decision-making. Emotional hygiene is equally important. After a difficult session, instead of replaying trades repeatedly in frustration, conduct a structured review. Identify whether errors were technical or emotional. Document lessons. Then close the platform intentionally. This closure prevents rumination from draining energy overnight. Another powerful practice is scheduling non-market time deliberately. Engage in activities unrelated to trading. This resets perspective and reduces over-identification with short-term results. Consider a trader who defines a weekly routine, 5 focused trading days with strict time boundaries, 1 day dedicated to performance review, and 1 full day completely disconnected from markets. Over months, his equity curve grows steadily. More importantly, emotional volatility decreases. By managing psychological capital, he prevents burnout and maintains clarity across cycles. Sustainable success is not built through constant intensity. It is built through balanced discipline. Markets will always present opportunity. Your capacity to engage with them fluctuates. Recognizing when your reserves are low is strength, not weakness. Emotional control extends beyond individual trades. It includes knowing when not to trade because your internal resources are compromised. Protect your focus as carefully as your capital. Over time, those who manage energy intelligently remain consistent while others burn out or spiral. Longevity in trading is competitive advantage. Longevity requires preservation. Guard your psychological capital. Replenish it regularly. Performance depends on it more than any indicator ever will. At some point, trading stops being something you do and becomes something you embody. Techniques, rules, risk parameters, journaling, patience, adaptation, these are tools. Tools are powerful, but they are not enough on their own. What determines long-term stability is the identity behind the tools. Professional identity is a self-concept rooted in disciplined execution over emotion. It is the internal standard that governs behavior regardless of recent wins or losses. When identity is stable, performance stabilizes. Many traders approach the market as participants trying to win. Professionals approach it as operators executing a structured process. The difference is subtle but transformative. If you see yourself as someone who tries to make money, emotional swings dominate. If you see yourself as someone who executes edge with discipline, behavior aligns automatically with structure. Identity influences reaction speed. When a trade hits stop, a reactive trader feels attacked. A professional thinks, that was one execution within distribution. When a trade wins, a reactive trader feels validated. A professional logs the result and moves on. Consider a trader who once struggled with impulsive entries and revenge trading. Over time, he builds routines, tracks data, and reinforces discipline. Gradually, his internal dialogue shifts. Instead of asking, "Can I win this trade?" he asks, "Does this meet my protocol?" Instead of thinking, "I need to recover," he thinks, "My job is execution." Months later, during a difficult drawdown, he notices disappointment but not panic. His identity no longer depends on immediate results. He behaves consistently because discipline is who he is, not something he occasionally attempts. Professional identity eliminates internal negotiation. When your standard is clear, you do not debate whether to widen a stop. You do not argue with yourself about increasing size after a win. You already know the answer. This identity is built through repetition. Every time you follow your execution protocol under pressure, you reinforce it. Every time you respect your risk unit despite temptation, you strengthen it. Every time you stop trading after reaching a daily loss limit, you confirm it. Language matters. Instead of saying, "I hope I trade well today," shift to, "I execute my system with discipline." Instead of, "I'll try not to overtrade," shift to, "I only trade valid setups." The words you use internally shape expectation. Environment also reinforces identity. Organized workspace, structured schedule, consistent journaling. These behaviors signal professionalism to yourself. Professional identity does not require perfection. It requires commitment to correction. When you deviate, you acknowledge it quickly, document it, and return to structure without self-judgment. Recovery is part of the identity. Over time, emotional noise decreases. Confidence becomes quieter, less dependent on outcome. Drawdowns feel manageable because you trust your process. Winning streaks feel controlled because you respect limits. Markets will continue to fluctuate unpredictably. Volatility will expand. Conditions will shift. Losses will occur. Wins will occur. Your edge is not in controlling the market. It is in controlling yourself consistently across all conditions. When discipline becomes automatic, trading feels less dramatic. You are no longer chasing excitement or avoiding discomfort. You are operating. Professional identity transforms emotional control from effort into standard. You sit at the screen composed. You define risk precisely. You wait patiently. You execute without hesitation. You review without ego. You adapt without panic. You rest without guilt. This is not a temporary mindset. It is a permanent operating system. Mastering emotional control in trading is not about eliminating feeling. It is about aligning feeling with structure. In the end, the market does not reward intelligence alone. It rewards consistency under uncertainty. Become the trader who values discipline more than excitement, structure more than impulse, process more than outcome. When that identity is stable, performance follows naturally. You are no longer trying to think like a professional. You are one